All right, good afternoon, everybody. Welcome from beautiful Chicago. Hope you're all doing well. A beautiful day today, not too hot, not too cold. All right, so we're going to talk about it's summertime, it's beach time, and it's also summer trading plan. And I'm excited to introduce a little bit of the summer trading plan today and introduce kind of a unique class. I haven't done anything like this before. Always looking to do something different, see if we could things that can be helpful. So here we go. This is for educational purposes today. So the class that I'm introducing today is just a free class. We're talking about it, going over some strategies. It's going to be something different that I haven't done. An 8-week class. Usually I've done 2 to 4 week classes. Here we're going to 8 weeks. And so I'll give you a little bit of information about this new summer class that will be focusing on shorter duration trades. Class will be 8 weeks. Again, 99% of the classes I do have been 2 to 4 weeks. Do I ever remember doing an 8-week class? No. It's a long time, but it'll be much more helpful because you're going through many weeks together. The start date would be June 19th, and the end date would be August 9th. So June 19th is going to be 2 weeks from today. So to go 8 weeks every Tuesday and Thursday from 11 to 11:30. We meet for a half hour during that. During each class, we'll be putting on the live trade for the day. We'll be following a plan through for 8 weeks together, right? And that's the big thing. Over an 8-week period, no matter what the market throws at us, we will be doing the 8-week plan, and I would put in a live trade at every class. And so this is definitely a class to help you do it, right? And we'll be doing it with you. Each class I'll put on live trade for the day with full 4-step risk management plan. So on Tuesday, we'll put the trade for Tuesday, Thursday, the trade for Thursday, and then I'll tell you the 4-step risk management plan. How do we set it up? What strikes to do? The width of the strikes, which trade, why this trade. That's all in the setup. And then step 1. Step 2, what's the profit target and max loss? That'll be different on particular trades. And then if we do get into, which we would, when to adjust step 3 and how to adjust. So we'll give you all that, and then I will follow up with emails for when I do something, if there's anything. All classes are archived and recorded. Class price is $597 for the 8 weeks, and it's a long class for us to work through, but I think the benefits could be crucial because we're going through 8 weeks, so you have a much better chance of continuing to do something and getting a little more independent on some of these strategies in 8 weeks than you do 2 or 4. As I said, live trades every class. We'll be doing the plan. I'll be doing the plan out loud. Plan of every trade given in class. There'll be, if I get student emails, I'll try to cover them in class because many are overlapping. And then is this for beginner, intermediate, or advanced? I think every level can take advantage of it. If I'm a beginner, should I look at this as a beginner that even if I don't know how to put orders in, I don't know anything, I'll take the class. Dan will make some money, so he'll cover the class, and he'll walk me through everything. Good luck. No. He said, Dan, what do you mean? How should the beginner look at this? The beginner should look at this. He might paper trade it and just see how is somebody doing it, right? My job over the 2 months isn't going to be to mentor somebody who doesn't have a clue. Agree? If you don't know how to put an order in, don't know what options are, that wouldn't be fair, right? To take you and just put you on my shoulder. That's not what this is for. Now, if you're a beginner and you know what an option is, know how to use your brokerage platform a little bit and do it, do I think you could do this? Yeah. I think this is for every level, but I just want to be clear what it is and what it isn't. So any questions on any of that? Any questions on any of that? So that's what the class will be. I think it's a great opportunity because I probably won't do an 8-week class. I haven't done one before. And so this is just a chance to really, for the repetition of doing it, right? You know how it is doing it on your own. Here I'm doing it together. And as I said, I'll be doing the plan, illustrating the whole plan live, right? The whole time. Any questions on that, or we'll just go, or I'll give you a second. If not, we'll go into spend a little bit of time on strategies, just talk a little bit about some of the strategies we'll be covering in the class. Starts 2 weeks from today, and give you an idea on that. And the neat thing is, do any of you know what the market will be doing during those 8 weeks? Is there anybody here who knows what the market will be doing during those 8 weeks? Here's the answer. No. Yeah. Lee says just a half hour per class. Yes. Yeah. If I did an hour per class, I'd have to jack the price up. It just eats up a lot more time. But again, it's not like I'm doing PowerPoints for every class. We're here to implement the plan. So each plan will be, I'm putting on the trade, showing you how I'm putting on the trade, showing you what the risk management is. Yes. And so I'm trying to keep the class price reasonable. It's an 8-week class. I think a wonderful opportunity for those of you who aren't consistent or haven't been doing it consistent. I don't think you're going to get a better opportunity. Everything's transparent. I'm doing the whole thing with you. And I think it'll be a good opportunity for 8 weeks. I can guarantee you I probably won't be doing another 8-weeker for a long time. And I just think that it takes a lot of practice to get better at this. Each class is 30 minutes, correct. Each class is 30 minutes twice a week. And for 8 weeks, and the purpose of each class will be we'll be implementing a plan for 8 weeks. And we'll be doing I'll be doing the trade live, be giving you all the risk management of each trade, which is plenty of time. So it won't be like a typical online class with plenty of PowerPoints. This will be a little bit different. All right, let us move on. Somebody said no sound. You guys can hear me okay, right? You can hear me okay? All right. So a couple of the, just to get into strategies a little bit, that's the class. So if we talk about probably, and we'll see, I'll make the final decision when we meet in 2 weeks what exactly the plan will be, but it'll be something like every Tuesday, do some type of calendar type or iron condor based on the volatility, and then Thursday a butterfly. Let me ask you, how many of you right now are doing this, right? Where you're doing every week, rain or shine, a consistent plan, and you're consistent with it? How many of you can say, Dan, the last 15 weeks or so, this is what I've been doing. I've been consistent with it. Good. Some of them are Sheridan students, so that's good to see, but it's good. And so I think if you've been doing it, it's good. I think this will be a help, just maybe get a little fine tuning to what you're doing. And for those who aren't doing it, good opportunity for that. Trades that may be covered in class, these are some of the types that I said with the plan, but we'll have a very rigid Tuesday we do this because of this, Thursday we do this, and then, you know, the hope is at the end of the 8 weeks, you're getting better at it, right? Or you're getting in, and you're able to take this and do more of it on your own. That's the objective. So this would just be an example of a 10-day butterfly. Will this be the exact duration of the trade I'll be doing? No, it'd be type of a trade. A question says, will you be covering adjustments? Yes, of course. And we'll be going through, you know, and the other thing is that in our community, we've been doing these trades every week for the last 4 months, and overall they've been fine, right? Overall, there's some bumps, and that's why I think it'd be good to go through it together. All right, so here's a 10-day butterfly. Here's an example of a 10-day butterfly trade. This would be an income-producing trade. And short-term trades would be considered something that is, 5 to 15-day trades. And you can call them short-term trades. You can call them weeklies, right? But weeklies can be a little confusing because the term weeklies, can you do a 30-day weekly trade today? Can you do a 40-day weekly trade today? Can you do a 50-day weekly trade today? Yes or no? Could you do a longer duration weekly trade today? Could you do a 40-day trade today? Yes. So do weekly trades mean all short-term trades? The answer is no. No. So would it be fair if I said we're going to do all weekly trades? No, because we're going to be doing short-term weekly trades, but maybe some short-term monthly trades. But the bottom line is it's short-term trades. Trades that have a duration of generally 5 to 15 days. And the other thing that's very important to note, folks, is these short-term trades means if we put a trade on a Tuesday, by the time we put a new trade, the same trade on the next Tuesday, it'll be off, right? And if we put a trade on Thursday, the trade we put on Thursday will be off by the time we put another one on Thursday. You say, why is that significant? Because we won't be overlapping capital. So can you use a lot less capital on 5 to 15-day trades than you can on 30 to 60-day trades to say if you're trying to get X amount of dollars per month? As Sylvester Stallone says, absolutely, right? All right, and that's a positive that you could use less capital. Is there more? Let me ask you a question. Is it more risky doing these shorter term duration trades than to do 5 to 15-day trades? Is it more risky than doing 30 to 60-day trades? Is doing shorter term duration trades more risky than doing longer term duration trades? I think Eric says the price risk is greater. A lot of people say yes. Here's my answer to that. Paul says he's been kicked out of the short-term trades lately with the market swings. We've got a lot of people do real well with these short-term trades lately, so I'm not sure exactly how you're trading them, Paul, but here's the answer to that. So here's the answer. Here's my answer to, is it riskier to trade 5 to 15-day trades versus 30 to 60-day? And the answer is yes and no, or maybe. You say, why? Let's talk about it. As Peter says, they do need more attention, right? They do need a little bit more attention. But let's take the journey. Is there more price risk in these shorter term trades? Absolutely. That question, is there more price risk on a 10-day trade than a 40-day trade? The answer is yes. But to get the whole story in, most of these 10-day or 15-day trades, is it true that a large percentage of the time, right? Is it true that a large percentage of the time for people who do these regularly on 5 to 15-day trades, is it true or false that a large percentage of the time you're out in a few days? You're out in 1 to 3 days. Is that true or false? It's true. So what does that mean? Is that significant? Is that significant or insignificant that your days in a 5 to 15-day trade may be 1 to 3 days per week, whereas your days in the trade per week on a 30 to 60-day trade you're generally going to be in all the time? That's significant. Why is it significant? Well, because if I can be out of the market almost 50% of the time on my strategy, it's significant that I'm going to dodge a lot of bullets, right? So yes, there's more price risk, but a lot of that is offset by the fact that I'm not in but 50% of the time. So yes, do you have more price risk? You do, and that's reality, but it's offset by the days in the trade. And the thing is, you have a ton of theta on these trades, so you can get out quicker, but generally you have more volatility risk on these longer term trades, right? You have more volatility risk on the longer term trades. So it's not yes, there's more price risk, but I think I want to be careful with the words here, but it's in my opinion, it's tremendously offset, right? And so again, now, am I saying that I recommend in our community that folk do more shorter term than longer term? No, I don't. You know, in the Sheridan community, I'll say for every $10,000 of trading capital, put 70% of the capital in 30 to 60-day trades or whatever, and put 30% in shorter-term trades. I'm just focusing on shorter-term trades here. One more question came in. It said, how will adjustments on non-class days work? Very simple. So the question says, during the class, how will adjustments on non-class days work? Very simple. They'll be emailed, but here's the key. What did I say at the beginning of this class was going to happen on every class? So every class, I'm going to put on the same trade or similar trade on Tuesday, and then a different trade on Thursday. But when I put the trade on, am I going to put the trade on and say good luck, or I'll email you? No, I'm going to put the trade on. I'm going to say how I put the trade on, why I put the trade on, what's my profit target, what's my max loss. If I'm going to adjust, where would I adjust? How would I adjust? Where I'm going to pick my toes, where I'm going to comb my hair, where I'm going to wash my face. Exactly. So based on that, will you know what to do? Based on what I'm going to tell you on each class, if you're listening, will you know what to do? Yes or no? Will I be clear as a whistle in telling you what I'm doing? Yes. Now, you say, Dan, I'm not going to listen to you. Well, then if you don't listen, you won't know. But if you listen, you'll know, right? And I'm also going to send an email if I do anything, right? But again, it won't be crystal clear. You'll know what I'm doing. You'll know everything. Now, again, if you don't know what you're doing, you don't know how to put an order in, you don't know what you're doing, you know, I would paper trade, because this isn't going to be, I can't spend an hour with you how to use your brokerage firm and what is a call and a put. It's just not, that's not the purpose of this class, right? So I'm assuming you understand how to use the brokerage platform. I'm assuming you have a clue, a beginning clue, but I think for beginners, it could be wonderful because of the repetition. Right? And you're not going to, there's nothing out there like this, right? If there's nothing out there like this 8 weeks that'll go through with you and give you this kind of information and do it with you, right? So, all right, let's go back to the butterfly. So here's an example of a butterfly, 10 days. So again, we put it on, I put it on today, Tuesday, and put it on a week from this Friday expiration, right? And trying to get my deltas closer to zero, position deltas, and it's just strictly, again, we're trying to get time decay. We're trying to get this theta on these short-term trades, be in the trade a few days and get out. And in this example, this would be a broken wing or unbalanced butterfly. Dan, what's a broken wing or unbalanced butterfly? So in this example, I'm selling, this is where the price of the underlying is. The green line is a sink or swim. It's the expiration graph, and the purple line is the graph today. So you have a picture of the graph today, what a graph looks like. The green line is the expiration graph. In red is the current price when I took the slide. Black would be the short strike, right? This is the strike, short strike. This would be called an iron butterfly. What is an iron butterfly? I'm doing a call credit spread and a put credit spread. What's the foundation of an iron butterfly? You're selling an at-the-money call and put. What's that called? It's called a short straddle. Why would I sell a short straddle? Because the most time premium on options are at the money. Why would I sell the at-the-money options? To get that time premium. That's where you get the most decay, right? If you're trying to make money from selling options. So these are all positive theta trades. We're selling options. The options we're selling, the at-the-money options, we're selling a lot more time premium in this type of a trade than the ones we're buying. Now, an iron butter, so I'm selling the at-the-money call and put, and then I'm buying a strike above my short call in the calls, and I'm buying a strike below the short put in the puts for hedges, right? Because if I just sell the at-the-money call and put, and you did that at your brokerage firm, they would want you to put up your wife, your children, your car, your town, your mayor for collateral. And most of you don't want to do that. So it's not a good, efficient use of your capital to be selling naked options unless you have like a portfolio margin account. Just not a good use of capital, period. You know, is there risk? Yeah, but it's not even the risk. It's not a good use of capital, right? If you look here, I'm selling the 2750 call, the at-the-money call and put. Why am I selling the at-the-money call and put? That's where the juice is. That's where the time premium. I'm buying my long call, in this instance, 25 points up. I'm buying my put 30 points down. So because I'm buying my long put 30 points down and my long call 25 points up, because it's a different number, this would be an unbalanced or broken wing butterfly. It's not equal distance, my longs from my shorts. And we'll get into that as far as why would we do that and what strikes we're picking. And that's the neat thing about the class. We'll get into the whys. Marvin Santos of the Santos family says, Dan, how long after the class will it be posted for review? Pretty close to, I don't know, the next year and a half or so. I mean, for quite a long time. So you can watch it. Up until Marvin, you can watch it at least 500 times after the class is over, all right? Maybe 501. So it'll be posted for quite a bit of time. And as you're going through the material, if you have questions, you can send an email. So this is kind of the structure. It's a butterfly. And you look at the P&L and you look at the green graph and you say, well, why does a butterfly make so much money if it kind of sits there? Anybody know? Why does this green graph go up like that? And why does it make so much money if it kind of sits at the money? Why is that? Why does this trade make so much money if it just kind of hangs around the short strike? Yeah, time decay. The options that we're selling, the 2750 call and put, decay at a much, much faster rate than the options we're buying. And if the stock closes at, now again, this is like hitting a bullseye, but if the stock were to close, the reason the graph makes its most money at the short strike at expiration in 10 days is because the short call and put that we sell for a lot of money would go to zero, right? We sold the call and put for a lot more money than we bought our hedges, the out-of-the-money call and put. So at expiration, if we closed at bullseye, which probably won't at the short call, theoretically that's where you'd make the most money. And you have less risk on the upside than the downside because you're narrower on your call credit spread than the put credit spread. So this would just be, but again, whether we called this a butterfly, whether we called this a hot dog, whether we called this the boogie hoogie, or whether we called this the woogie woogie, it doesn't matter, right? This is just a structure to take advantage of time decay and we're going to rely on a good plan and good risk management to extract money out of this. And if we can't extract money out of this, we're going to rely on good risk management and a plan to keep your losers near your winners. That, gentlemen, is the name of the game. That's trading. Trading isn't waking up in the morning and saying, which way is the market going? I will go with that. Boom. Which way is the market? Who the heck knows? If any of you, right, Richard Borowski from the famous Borowski family hot dog stand in Chicago says, Dan, can't you make that call site almost bulletproof? I wish I could, Richard. I don't know what bulletproof means. I like the word bulletproof, right? You know, is there ways on the upside we can dramatically reduce the risk and all that stuff? Yeah, we'll talk about that in class, but we're talking short-term trades, simple, effective plans, and making sure you can get out of these trades at reasonable price. All right, anyways. Another trade we'll be taking would be the 13-day, you know, again, we're not going to use a 13-day, but again, a short-term, be looking at iron condors and when to put on iron condors and when you would put iron condors and when you wouldn't. When you'd put on iron condors and maybe when you put on a double calendar, because what is an iron condor? If this is the underlying price, an iron condor is selling an out-of-the-money call and an out-of-the-money put. What's an iron butterfly? Selling an at-the-money call and put. What's an iron condor? Selling an out-of-the-money call and put, right? That's the foundation. What's the foundation of a double calendar? Selling an out-of-the-money call and put. What's the foundation of an iron condor? Selling an out-of-the-money call and put. And then, so an iron condor is different than an iron butterfly because iron condor, you're selling an out-of-the-money call and put. Iron butterfly, you're selling an at-the-money call and put. So the butterfly, which one would be more beneficial for which trade would have more time decay? Iron condor or iron butterfly? Which trade would have more time decay? Iron butterfly, yeah. So here's an iron condor. So this is an iron condor, and I want to get the deltas again at the beginning near zero. We'll get into a lot of the mechanics. But this particular iron condor, I'm selling a call credit spread, and I'm selling a put credit spread. And I'm getting, in this case, on a short-term trade, on a 13-day trade, I'm getting about $1.85. So my margin is $8.15. Dan, how do you get margin of $8.15? Well, my risk is $1,000, because 10 wide spreads, 1,000 less the credit. So each one iron condor is about $815. Now, for beginner people in class, you say, Dan, that seems like a big trade. For beginners and people maybe with not a lot of experience, when you have an alternative, yeah, we'll give a little more like a Mr. T starter kit. Instead of 10 wide, you could do 5 wide. And that'd be maybe a $300 trade or a $350, right? So I'll give you some ideas during this if you want to put even less capital at risk. I'll give you can just narrow it. Instead of a 10 wide iron condor, you could do 5. Instead of a 30 wide butterfly, you could do 20. You get it? The question says, how do I control vega risk? 2 ways. Number one, first of all, these trades are short-term trades. So the vega risk is much less than the price risk. They don't get exercised early. They're not cash settled. So again, if it's a 10-day trade, we're typically going to be out of this in 2 or 3 days. So are we going to have to deal with getting exercised or getting assigned or all these other problems? No. Why aren't we going to have all these other problems? Because we're not going to be in Dodge City at the end, right? So we're not going to deal with exercises, assignments, boogie woogies. We're not any of this stuff, right? We'll put the stinking trade on, and we're going to take the stinking trade off, right? That's it. And we're going to learn what we're doing. And again, these are short-term trades, and so what you're going to see demonstrated is the power of what? The power of theta. The power of theta, right? That you can get in and out of these trades, so you won't be dealing with assignments and all this stuff, which is good, Robert, which is good. So anyways, so this is an iron condor. You're selling, in this case, the 27.95 calls, which are like 43 points out of the money, and the 26.80 puts, which are 62 points out of the money. So an iron condor, which is nice, you're not getting the time decay of an iron butterfly, but what do you get? You get a lot more room, right? The butterfly is like the graph like this. Iron condor gives you more room. So is one better than the other? No, there's pluses and minuses. They're both good trades. And we'll give parameters when we do an iron condor and when we would do an iron condor alternative, a double calendar. Dan, what's the difference between an iron condor and a double calendar? Well, again, an iron condor is basically saying, I'm going to start with the same foundation of an iron condor, selling out of the money call and put relative to the current price. An iron condor says, I'm going to buy my hedges, my out of the money call and put in the same expiration. A double calendar type trade is saying, under certain circumstances, I'm not going to buy my hedge in the same expiration. In this case, it's me. I'm going to buy my hedge, right? Instead of in the same month, I'm going to buy my hedge at a further out expiration. So anyways, well, that's just an example. I didn't want to take too long, but if you have any other questions, you could email me, Dan@SheridanMentoring.com. Questions about these strategies or question about the class, and I'd be happy to help you. But and I'll stay on here for a minute or so if you have any other questions. But it's just, I think it'll be a fun time for 8 weeks. Get to know each other, work together on the craft together, and I think this would be one of the best opportunities you'll ever have to do it, because how often you can get someone to work with you on every aspect of it, the live trade, the risk management, showing you what you do for 8 weeks. And so that way I think it'll help you get a little more independent. How large of an account do I need to fully participate? As far as this class, you can do a paper trade, or if you're going to do on your own, if you were going to do a live trade, again, I don't know I'm recommending paper because I don't know you, a lot of you. So I don't know your level of, but you can do these types of trades, you can do it a couple $1,000s. Is margin on the iron butterfly 1,000 or 3,000? If you look at this trade, the margin's 1,000. So if I'm doing a butterfly, I'm selling the 27.50 calls, buying the 27.75s, selling the 27.50, buying the 27.20. The width on the put credit spread is 30. The width on the call credit spread is 25. The way you determine how much risk or capital on this trade is you take the width of the largest side, which is the put side, which is 30. So for every one contract, I have my capital requirement is 3,000 less my credit in an iron butterfly of 2,000. So every one butterfly, how I constructed it here, it would be $1,000. What time will the classes be held? For 8 weeks, Tuesday and Thursday at 11 Central. Tuesday and Thursday at 11 Central. Even if you can't make it, the classes will be archived. The archives should be up probably within an hour after the class. The class trades and my risk management plan should be up probably within 15 minutes after the class. For those who bribe me with food, I will come to your I will come to your place of work. I will come to your house. I will bring you the trade. I will hug you. I will embrace you. I will love you. We'll see you in 2 weeks. It should be a fun opportunity. 8 weeks together. We'll bond. We'll laugh together. We'll cry together. We'll learn a lot. And we'll see you in 2 weeks from today, 11 a.m. sharp. We'll go from there. So have a great day, everybody. All right, we'll see you later. Thanks.